All right, for most everyone, following the basic money rules is the path to success. But of course, with rules, there are exceptions.
Knowing when to break a money rule can be key to long-term financial success, says our financial expert, Annie Manningly, who is here in studio to help us become rule breakers. I like where you're going with this. So let's go through some of the basic rules. Is it always a smart financial decision to pay off your debt as quickly as possible?
Well, if you have debt that's like for a home that maybe helps you reduce your taxes and you're not fully contributing to your 401k, then you shouldn't focus on that. You should get to your retirement savings and leave that debt alone and just keep paying it normally.
What about that debt with the high interest rate? Always pay that off?
That's usually a good rule of thumb, but you need to look at the reason why you're trying to get out of debt. Maybe you need more money in your monthly budget, so instead of focusing on the high interest rate, focus on the debt that has the highest payment and pay that off first, or maybe the one with the smallest balance. So you got to kind of look and not always follow that rule.
So is saving 10% of your income toward retirement always a good rule to follow?
That's a good rule to follow if you start that before you're 30. But if you're after 30, you got a lot to catch up, and so you should break that rule and start trying to get as much above 10% of your income saving for retirement as quickly as you can.
All right, what about this rule that we've heard before? Buy a house that costs 2.5 times the amount of your annual income.
That's usually a good rule of thumb, but you know, today people have more debt, like student loans and things like that. So you got to kind of look at that and say, can I really afford this payment? So you got to look at that. So maybe a little less. And if you're going to move in 5 years, maybe you don't want to spend that much. You want to get a little less.
Okay, so what about the rule of saving for college as soon as your child's born?
Well, if you do that, you're probably going to have enough to pay for their college. But if you're not saving for your retirement, you need to break that rule because you need to save for your retirement first. You can find other ways to fund your college, but there's only one way to fund your retirement.
On it, first of all. Should all of your emergency funds be saved in a readily available savings account?
Yeah, a lot of people talk about having all of your emergency funds there, but usually you don't need all of it at once. So put about 90 days there and then put the rest of your emergency funds somewhere else where you can earn a higher interest rate. Maybe it's a certificate, maybe it's in the market, but you only need 90 days readily available and then start putting the rest of that somewhere else.
All right, great ideas, man. Thanks so much.
You're welcome.
He's a wizard.